Hey everyone, welcome to Turnmycoin YouTube channel. We help you make loads of serious money by educating you about Bitcoin and cryptocurrencies so you can make informed decisions before investing in cryptos. The cryptocurrency market is full of intricacies. It has loads of complexities which, if properly analyzed, can provide high returns and, on the flip side, high losses. We are going to discuss some of the tricky topics in this article, namely bull trap, bear trap, and block trading. Please note this article is for informational purposes only. Cryptocurrency is a volatile field. Please do your own research before investing. To become a better and more profitable cryptocurrency trader, you need to understand: what is a bull trap? What is bear trap? How do they work? And more importantly, how to avoid them. Furthermore, we will also discuss a unique concept that acts as a protection against price increment when you bulk buy your cryptocurrency. It is termed block trade. Please like and subscribe to Turnmycoin channel to help us keep the content updated and provide you with more educational videos. What is a bull trap? When a downward trend in a stock, index, or other investment reverses after a strong rise and breaks through a previous support level, it is termed as a bull trap. In other words, a bull trap is when, during a downtrend, a trader or investor buys security that breaks out above a resistance level expecting its price to increase due to the breakout and the prices drop beyond the previous level of support. Bull traps develop psychologically when bulls fail to support a rally above a breakthrough level. That could be due to a lack of momentum or profit-taking. How does bull trap work? It's difficult to see a bull trap since generally, after a breakout, an asset's price will rise rather than fall. What you can do, though, is perform technical and fundamental analysis on the item you intend to trade. Check to see if the asset is currently overbought, as this could signal a negative reversal from the current positive trend. You might also wait to see if the bullish trend continues before establishing a long position after a breakout. The Relative Strength Index is a prominent technical indicator for identifying overbought assets, RSI. When attempting to avoid a bull trap, a trailing stop will trail behind the current market value by a certain number of points and will immediately close your position if the market value drops by the set amount of points. This will allow you to lock in as much profit as possible while also preventing you from falling into a bull trap early on. How to avoid the bull trap? Bull traps are best avoided by recognizing warning indications ahead of time, such as low volume breakouts, and exiting the transaction as soon as possible if a bull trap is suspected. 1. Use stop loss. You can call this a ritual when you trade. As investors, we often get emotional about holding and selling our cryptos. The cryptocurrency market is unpredictable. Prices may fall and fall beyond imagination. The best way is to get out of the market at the right time. Stop loss is one such tool that can shield you from losing too much if it is properly used. Standard, trailing, and guaranteed stop losses are the three types of stop losses available. 2. Avoid late entries. A lengthy sustained rise is usually a potential sign of this crafty pattern, according to the descriptions of a bull trap. In other words, the longer an uptrend has been going, the more probable it is to become a trap. However, a trader can avoid bull traps by avoiding late entry. It is preferable not to trade a trend that has been running for a period regarded as too lengthy. 3. Don't buy at resistance levels. The phrase "trade with the trend" is one of the most used in the trading business. Buying at support levels and selling at resistance zones is the only method to do this. If this principle is to be respected, a trader should never attempt to purchase at resistance levels. However, there are exceptions, such as when the price retests the zone after breaking it, confirming the start of a new trend. Nonetheless, purchasing at resistance levels is riskier than buying at support levels. 4. Wait for retests. There is no hard and fast rule that purchasing at resistance turn support is a bad idea. Traders understand that when a support zone is broken, it transforms into a resistance zone. Similarly, when a resistance zone is breached, it becomes support. In a word, before executing buy orders, a trader should always wait for the price to not only break through a resistance zone, but also retest it and acquire upper momentum. 5. Observe price action. Price action can help traders escape bull traps. The true behavior of the price at any particular time is referred to as price action. Now, as a bull movement approaches a resistance level, the trader should pay attention to what happens to the price. What is a bear trap? When the price of a stock, index, or other financial instruments continues an upward trend after breaking support, it is called a bear trap. It implies a reversal from a negative to an upward trend. The concept of a bear trap is somewhat opposite to a bull trap in respect of price action. Institutional traders, according to technical experts, strive to set up bear traps to entice regular investors to take long positions. How a bear trap works. When stocks are purchased, there immediately becomes a selling pressure on that stock, as investors only profit when they sell. As a result, if too many individuals buy the stock, the purchasing pressure will decrease and the potential selling pressure would increase. Institutions may decrease prices to promote demand and raise stock prices, making the markets appear negative. As a result, inexperienced investors sell their investments. When a stock's price falls, investors rush back into the market and the stock's price rises in response to the increased demand. How to avoid a bear trap? To begin, you can use the volume or technical indicators described to try to spot a bear trap. 1. Stop loss. It is similar to what I had discussed while covering a bull trap and is totally relatable. So we move on to illiquid markets. 2. Avoid illiquid markets. Bear traps are more common in illiquid markets when there are fewer players. Bear traps can be avoided by avoiding illiquid markets. 3. Volume indicator. If the volume of trade of a particular cryptocurrency does increase, there are low chances of the price going down any further. Volume indicator depicts the strength of a bear trend in question. What is block trade? A block trade, in simple terms, is the exchange of a large number of cryptocurrency coins. A legal definition of a block trade has yet to be approved by Congress or the SEC, and the word is frequently misused. The majority of block deals involve far greater sums of money. Additionally, while investors can potentially make block trading on any financial market, the majority of block trades involve stock or bond shares. As a result, the majority of block trading involves equities and debt markets. It is not very popular in cryptocurrency at this point. Institutional investors, such as funds or businesses, virtually always engage in block trading. Advantages of block trade. Because of their willingness to take on a huge trade, both the buyer and the seller earn better prices. In addition to the price advantage, the customer can make use of the following additional advantages. Economies of scale. In this situation, the investment manager's smaller underlying investors can achieve the same price benefits as a large institutional trader by pooling their assets together. Fee savings. When you buy a large number of shares in a block trade, you pay a single fee for single deal execution, rather than a fee per purchase, per client. Intraday trading flexibility. Using block trades to trade intraday increases flexibility. For example, if an advice business buys a block of coins early in the day and the price rises, it can keep adding to its previous position throughout the day, and all of its customers will get the same average price. Back office simplicity. Block trading can save time and money in the back office, especially for smaller investors or advisors. It is considerably less time-consuming to assign one trade rather than performing 100 separate trades. Block trade disadvantages. There are several advantages to blocking trades. There are some problems with it as well. High-frequency traders, HFTs, benefit from latency arbitrage and quicker access to dark pools. Block trades have also been condemned for not being too beneficial for institutional investors. Block traders may get an unfair edge over retail trading as a result of this. To sum up, when trading cryptocurrency, bear and bull traps are two of the most typical trading dangers. You can use the methods we discussed to safeguard your investments. Furthermore, the use of block trade can shield you from sudden variation in price, but many times it can be misused by large investors to manipulate the market. For more educative videos on Bitcoin and cryptocurrency, subscribe to our channel Turnmycoin. Until next time, keep minting loads of money, winky face.